Welcome back to the Deep Dive. It is Tuesday, February 24th, 2026. And look, if you've glanced at your portfolio this morning, or really any time in the last 48 hours, you probably saw a lot of red.
A lot of red. It's pretty ugly out there today.
It really is one of those days where the best financial advice might just be to go for a walk. Leave the phone at home and just touch some grass.
Highly recommended, yeah.
And this is exactly why we do these deep dives.
Hmm.
If you only look at the price action, you are missing a massive, glaring disconnect. Because we have a stack of sources today that paint two completely different pictures of reality right now.
Yeah, on one side, you have the world basically on fire. You've got tariffs, war threats, panic selling.
That is the macro noise.
Huh.
And it is absolutely deafening right now.
It really is. But then on the other side, if you look at the actual infrastructure, like what the smart money is doing and not what they're necessarily tweeting about, it looks like a completely different industry.
It looks like a boom.
Exactly. It's a classic case of price versus value. We are seeing this geopolitical storm crashing the market sentiment, but underneath the plumbing of the financial system is being rebuilt faster than ever. The checkbooks are open, even if the retail trading apps are being deleted from people's phones.
So that is our mission today. We are going to separate that macro noise from the structural signal. We need to talk about why Bitcoin is crashing, sure, but also why the derivatives data suggests a short squeeze might be imminent.
Which is a huge structural signal.
Right. And we also have to unpack Ethereum's identity crisis. I mean, Vitalik is selling, but the foundation is doing something very interesting with staking that changes their whole business model.
And we absolutely have to follow the venture capital money. Because while retail investors are panic selling, VCs poured over $2 billion into the sector just in the first quarter of this year.
And they are not buying meme coins.
No, they definitely are not. They're hunting for something else entirely.
All right, well, let's start with the pain. Let's look at the fear part of the equation. Bitcoin has broken below that psychological support level of $64,000. I think we're trading around $63,950 right now.
Yeah, and the sentiment matches the price perfectly. The fear and greed index is sitting at a 5 out of 100.
Wow, a 5.
Yeah, that is extreme fear. In technical terms, we usually call that capitulation territory. People are just throwing in the towel.
It feels like just last week we were stable, though. We were ranged. What changed so quickly? Why the sudden drop off the cliff?
Well, the primary catalyst came straight from the White House. President Trump announced 100% tariffs on Chinese imports.
100%. That is
Yeah.
a massive jump. I thought the baseline was hitting around 15% globally.
It was. So jumping to 100% is an economic shockwave. When you slap a tariff that size on a major trading partner, markets immediately panic about global growth slowing down.
Because everything suddenly costs more.
Exactly. They assume inflation is going to spike because consumer goods get vastly more expensive. And so investors go into full de-risking mode. They sell anything perceived as volatile.
And crypto is always the first thing to go in a liquidity crunch because it trades 204/7. Is the easiest thing to sell on a Sunday night.
That is the exact logic. And it is not just the tariffs. We have secondary stressors in the source stack, too. Heightened tensions between the U.S. and Iran, with reports suggesting military action could happen within 10 days.
Right, following that threat on Truth Social.
Yes. So investors are terrified of trade wars and real wars simultaneously.
Which is just a toxic cocktail for risk assets.
Which drives the flight to safety. Just look at gold. Gold is up 17% year to date. It is hitting a market cap of over $36.4 trillion. People are parking their money in shiny rocks and pulling it out of digital assets.
We're definitely seeing that in the ETFs, too. I was looking at the flow data for BlackRock's IBIT fund, and it looked grim.
It has been a bloodbath, frankly. We're looking at 5 consecutive weeks of outflows across the ETF sector, totaling $3.8 billion.
Wow.
And when you see BlackRock bleeding assets, it weighs heavily on the psychology of the average retail trader. It validates all that fear. It makes you think, well, if BlackRock's clients are leaving, maybe I should too.
Okay, so that is the bear case. That is why the screen is bleeding red. But you found something in the data, specifically in the derivatives market, that suggests this might actually be a trap for the bears.
It is a very distinct possibility. This drop below 64,000 triggered a massive flush. We saw about $507 million in liquidations happen almost instantly.
Just so everyone is on the same page here, that means the over-leveraged long positions, the people betting with borrowed money that the price would go up, they got wiped out.
Correct. Their positions were forcibly closed by the exchanges, so the weak hands or the overextended leverage is gone. The market is cleaner in that sense. But now look at the other side. There's a massive imbalance of short positions stacked up right above the $70,000 mark.
These are traders betting with leverage that the price will keep falling.
Heavily short. And that creates a fascinating setup. If Bitcoin can just reclaim 67,750, which honestly isn't that far away historically speaking, those shorts start going underwater.
And then they have to buy Bitcoin to cover their losses and exit the trade.
Which increases the demand, which drives the price up, forcing the next guy to buy.
The classic cascade, forced buying.
Exactly. It could trigger a rapid move straight up to 75,000. That is the basic mechanics of a short squeeze. The bears end up fueling the bull run against their own will.
And fundamentally, looking at the actual network health, does the blockchain itself even care about the price drop?
Not at all. And this is a crucial point to remember. We saw a hash rate dip back in January that had people worried about a miner death spiral.
Basically, miners turning off their machines because they were operating at a loss.
Right. But the hash rate has entirely recovered.
So they turned the machines back on.
They did. Miners are profitable right now, even with energy prices as low as 7 cents per kilowatt hour. That means the network is highly secure. The business of mining is healthy. The underlying machine is working perfectly. It is just the market sentiment that is broken.
And we have some potential tailwinds coming up on the calendar too, right? I mean, the 20 millionth Bitcoin is about to be mined.
Next month, actually. March 2026. It is a symbolic milestone, sure, but it reminds everyone of the digital scarcity. There will only ever be 21 million. Plus, looking at the political landscape, we have the Clarity Act moving through Congress and the appointment of Kevin Warsh as the new Fed chair.
Warsh is generally seen by the markets as much more favorable.
Much more so than the previous administration. So the macro looks ugly today, but the mechanics, the mining, the supply shock, the regulatory horizon, they are tightly coiled for a rebound.
Speaking of mechanics, we really need to pivot to Ethereum. Because if Bitcoin is dealing with macro noise, Ethereum feels like it is dealing with an identity crisis right now, or at least a very confusing public relations moment.
Identity crisis might be a strong word, but it is certainly a shifting narrative.
Well, the optics are just weird. On one hand, you have Vitalik Buterin, the face of the project, selling roughly $7.1 million worth of ETH recently. And you know when the founder sells, people get nervous. It looks like he is cashing out.
It definitely creates bad headlines. Retail sees that and panics.
But then practically on the same day, the Ethereum Foundation announces they are staking 70,000 ETH from their treasury.
It feels completely contradictory, right? But the Foundation's move is actually the much bigger story here. Historically, the Ethereum Foundation held ETH and sold it whenever they need fiat to pay developers or host conferences or just keep the lights on. They were a consistent net seller.
Which suppresses the token price. Every time they pay a major bill, the market feels that sell pressure.
Right. So staking 70,000 ETH signals a massive strategic shift toward an endowment model. They are now earning yield from staking rewards to pay their bills. They do not have to sell the principal anymore.
That is a huge sign of maturity. It is like a university endowment living off the interest rather than spending the tuition fees directly.
Exactly. It signals they believe staking is a secure, viable, long-term income stream. They are essentially eating their own cooking.
But here's the problem that I think frustrates a lot of retail holders, and I see this in our listener emails all the time. The fees. I was looking at gas prices this morning, and it was 0.038 gwei. That is effectively zero.
It is practically free to use the network right now.
Which is great if you're a user just trying to send money. But the whole ultrasound money narrative, the bull case for holding ETH for the last few years, was based on the idea that high fees would burn ETH and reduce the overall supply. If fees are zero, the burn is zero.
And that is the fee trap. With fees this low, Ethereum is technically inflationary again. The supply is actively growing. The network is busy. Transaction counts are actually very high. But because of layer 2 solutions and efficiency upgrades, that activity isn't generating the burn that traders want to see.
So the technology basically got too efficient for the token price's own good.
In a way, yes. The value is accruing to the users in the form of incredibly cheap transactions rather than to the holders in the form of deflation.
So where's this going then? I saw the protocol priorities update for 2026 in our sources. Is the roadmap addressing this fee issue at all?
Not in the way short-term traders might hope. The roadmap is incredibly focused on what they call scale, improve UX, and harden L1.
Harden L1, that sounds very, I don't know.
Oh.
Enterprise. It does not sound like we're going to the moon anytime soon.
It is enterprise. They are talking about things like EPBS, which stands for Enshrined Proposer Builder Separation.
Okay, pause. You cannot just drop enshrine proposer-builder separation and not explain it. That sounds like a 19th century legal doctrine.
I know it really does. Think of it like this. Right now in the Ethereum machinery, the people who build the blocks of transactions and the people who propose them to the network can potentially collude to extract value or censor certain transactions.
Like a chef and a waiter working together to overcharge a customer and split the difference.
Something exactly like that. ePBS splits those roles firmly at the code level. It separates the powers so no single person or entity controls the block construction. It makes the network vastly more neutral and censorship resistant.
It makes it harder for a hostile government or a massive corporation to control the chain.
Exactly. And they are also adding ZK-EVM attesters. Basically, they are trying to make Ethereum the most secure, boring settlement layer in the world. They aren't trying to pump the price for next week. They're trying to make sure that when BlackRock or the European Central Bank settles a $1 trillion transaction, the base layer is completely bulletproof.
So they're building the bedrock while retail investors are screaming for a price pump.
That is the disconnect in a nutshell. Institutional trust requires boring, predictable, secure upgrades. And that is exactly what the 2026 roadmap is delivering. It's just an infrastructure week every single week.
Which honestly is a perfect transition to our next segment, follow the money. Because if retail is screaming about the price going down, the venture capitalists are quietly writing massive checks into that boring infrastructure you just mentioned.
Huge checks. We are tracking over $2 billion invested in the crypto sector just in Q1 of 2026 alone.
And remind the listener, this is Q1 2026. The market is down. Sentiment is terrible, as we established. So what are they buying? Because if they aren't buying the volatile tokens, they must be buying the equity.
They are absolutely buying the infrastructure. The classic picks and shovels play. They're betting on the rails, not the trains.
Give us the highlight reel from the sources. What is the biggest signal in that $2 billion stack?
The biggest story has to be BitGo. They just completed an IPO on the New York Stock Exchange under the ticker symbol BTGO.
A crypto custodian going public on the NYSE, that feels like a massive watershed moment for the industry.
It is unprecedented. They debuted with a $2.08 billion valuation. This is the first dedicated crypto custodian, a company whose sole job is to hold private keys securely, to go public. It completely legitimizes the custody business.
It tells the traditional financial world that holding crypto for institutions is a real, regulated, and highly profitable business. It is not just some guy with a hardware wallet in a safe deposit box anymore.
Exactly. It is no longer a dark art. It is a publicly traded service with strict quarterly audits. And then you have a company like Rame. They just raised $250 million.
And I'm guessing they aren't building a new blockchain to try and kill Ethereum, right?
No. They are building enterprise-grade payment rails. They are helping massive legacy companies, think like Western Union issue stablecoin-backed Visa cards.
So using stablecoins on the back end to make the plastic credit card in your pocket work faster and cheaper.
Precisely. It is not about retail speculation. It is purely about utility. It is about back-end efficiency. And then there is Black Opal. They raised $200 million for real-world assets. Specifically, they are tokenizing Brazilian credit card receivables.
Tokenizing Brazilian credit card receivables. That is incredibly specific. And honestly, it sounds incredibly boring.
It is boring, but it is a massive global market. Think about it. Credit card debt is a financial asset. Someone owes that money, and someone else is collecting interest on it. Black Opal is taking that debt, putting it on the blockchain, and allowing global investors to trade it and earn that yield.
So they are taking messy, real-world global debt and turning it into a highly liquid digital asset.
Yes. This is exactly what we mean when we say the industry is maturing. VCs want recurring revenue now. They want custody fees, transaction fees, yield from actual debt. They do not want to bet on whether a dog-themed coin goes up 100x anymore. They are essentially done with the casino.
It is moving from a casino to a utility company.
That is the perfect analogy. The casino is still open for the gamblers, sure, but the big smart money is investing in the power plant that keeps the lights on for the casino and the hotel next door.
But for that power plant to run efficiently, you need permission from the regulators. And surprisingly, looking at our next set of sources, we actually have some news from the Federal Reserve that isn't terrible.
For once, yes, it is quite positive. We have the protocol from the January 27th and 28th Fed meeting. Now, the broad macro outlook is still showing sticky inflation, largely due to those 100% tariffs we mentioned earlier. The market currently expects a rate pause in March.
So no immediate rate cuts to come save the markets.
Probably not until much later in 2026. But the real nugget of good news is hidden deep in the regulatory details. The Fed is officially proposing a rule to formally end Operation Choke Point 2.0.
Operation Choke Point. It always sounded like a bad spy movie title. For the listeners who managed to block that out, remind us what that actually was.
It was an informal, coordinated pressure campaign where U.S. banking regulators heavily encouraged banks to drop crypto clients by vaguely citing reputation risks.
So a bank would basically say, look, we can't bank your crypto company, not because you broke any laws or because you don't have capital, but simply because you look risky to our general reputation.
Exactly. It was a soft shadow ban on the industry. You couldn't even get a basic payroll account to pay your employees. This new proposal finally removes reputation risks as a valid standalone reason to deny banking services.
That is huge. It means companies like BitGo or Rain can actually get normal bank accounts like normal software businesses without the constant fear of being debanked overnight.
It totally clears the runway for American crypto companies to operate properly. But here is the geopolitical twist. While the U.S. is finally fixing its banking access, Europe is actively trying to build its own rails entirely from scratch. We need to talk about the digital euro.
Right, Christine Lagarde.
Yes.
This is basically her legacy project at the ECB, isn't it?
It absolutely is. She might be stepping down before her term officially ends in 2027, but she is pushing incredibly hard for this before she goes. And the rhetoric in the source material has completely shifted recently. It is no longer just about modernizing payments or consumer convenience. It is fundamentally about sovereignty.
Sovereignty from whom, exactly?
From the United States. Europe has fully realized that they are incredibly dependent on U.S.-based payment rails like Visa and MasterCard and on U.S. dollar-backed stablecoins.
So if geopolitical tensions get worse, and we clearly know they are, Europe does not want their entire domestic economy held hostage by American tech and financial companies.
Precisely. The digital euro is being explicitly framed as a geopolitical financial shield. And the potential successors to Lagarde, people like Joachim Nagel or Isabel Schnabel, they might disagree on exactly how fast to roll it out, but they all fundamentally agree on one thing. Europe absolutely needs this to counter big tech dominance.
So we have the U.S. regulators finally stepping back from the chokehold and Europe stepping up to build a digital fortress. It really highlights how critical this infrastructure has become on a global scale. Is national security now.
It is definitely not just internet money anymore. It is state-level geopolitical strategy. It is about who ultimately controls the flow of global value.
Before we wrap up, we have to hit our quick hit segment. These are two stories flying a bit under the radar that I think are going to be massive later this year. First up, we have Solana.
Solana is a bit of a mixed bag right now, to be honest. Network activity is at absolute record highs. The chain is buzzing, meme coins are flying, the daily active user numbers are fantastic, and everyone is waiting for the Fire Dancer upgrade in 2026, which promises to make the network even faster and significantly more decentralized.
But raw speed isn't everything if the vaults aren't actually safe.
Right. And that is the dark cloud. The ecosystem took a massive hit with a $27 million hack recently. It forced Step Finance and its key subsidiaries, specifically Solana Floor and Remora markets, to essentially shut down operations.
Shut down, like completely close the doors.
Winding down, yes. It is a very stark reminder that even with incredibly high user activity, security vulnerabilities can still kill legitimate, thriving businesses overnight. It is a serious growing pain for the ecosystem. You can have the fastest car in the world, but if the brakes fail, you still crash.
And for our second quick hit, this one honestly blew my mind. Ghost GDP. This comes from a fascinating new Citrini research report. What in the world is ghost GDP?
This is a wild and honestly slightly terrifying economic concept. So we have all these AI agents operating now, right? Autonomous software doing complex tasks, writing code, generating marketing content, even executing trades.
Right, the whole AI digital workforce.
Exactly. Ghost GDP refers to the economic output generated by these AI agents that shows up in the national data. It looks like real productivity, it looks like corporate growth, but it fundamentally does not circulate in the real human economy.
So the AI agent makes money and creates corporate value, but it obviously doesn't go buy a sandwich at lunch. It doesn't pay rent for an apartment.
Exactly. No human wages are paid out for that specific productivity. Therefore, no consumer spending follows that generated income. The value just stays locked inside the digital corporate loop.
And this concept is actually causing anxiety in the traditional markets.
Massive anxiety. because it is creating a very real fear of profitless growth, or more accurately, corporate growth, that deeply isolates the human workforce. It heavily contributes to the fear of sweeping white-collar layoffs. If a country's GDP goes up but nobody has a physical job to buy the goods, the entire consumer economy breaks down.
That adds a whole new terrifying layer to the macro gloom we started with. It is not just about tariffs, it is the fundamental structure of the human economy changing.
And it severely complicates the Fed's job, too. Think about it. How do you accurately measure inflation or employment health when a massive chunk of your overall economy is ghost output produced entirely by software algorithms?
So let's try to synthesize all of this for you. We started today with a sea of red. Bitcoin is down below. 64K tariffs are spiked to 100%. War threats are looming globally. The vibes are undeniably bad.
The vibes are terrible. But underneath that noise, the structural signal is incredibly strong. The BitGo IPO proves the custody business model is real and regulated. The Ethereum Foundation is acting like a mature global endowment, securing its long-term future. And VCs are pouring billions into boring stablecoin infrastructure and real-world assets.
It really feels like the retail price is reacting to the world Trump-Iran tariffs. But the underlying industry is just busy building the future, almost completely ignoring the price action.
That is the grand decoupling. The daily price is volatile, but the global rails are being laid down permanently.
So here is the provocative question we want to leave you with today.
Yeah.
And it comes directly from connecting those dots between the ghost GDP concept and the digital euro.
Right. If we are moving into an economy where value is increasingly generated by non-human machines, AI agents creating all this ghost GDP, and that value is legally settled on digital rails controlled strictly by central banks for the sake of sovereignty, where does that leave the individual private investor?
Right. If the machines make the money and the government tightly controls the rails.
Are we rapidly moving into a world where you simply cannot access or transfer value without explicit state permission? And if so, does that finally explain why, despite the terrifying price drop today, the decentralized insurance of crypto, things like Bitcoin and Ethereum, is the one asset class the massive institutions are quietly trying to secure for themselves while retail panics and sells?
That is definitely something for you to chew on while you watch those red charts today. The short-term volatility is incredibly painful, but the long game has never been more interesting.
Stay safe out there.
Thanks for listening to The Deep Dive. We will catch you next time.